Well, now it's time to find out more about the democratization of alternatives, where, when, and how that impacts investors. So we've got for you David Elms, Head of Diversified Alternatives, Luke Newman, Absolute Return Portfolio Manager, and Adam Hetts, Head of Portfolio Construction and Strategy. Adam, I'm told you are facilitating this session, so I'm handing over to you.
Okay, thank you, Sarah, and thanks to everyone in the audience for joining. And like you just heard Alex Crook say, there's a big tug of war in markets right now and portfolios between offense and defense, which really makes this environment right for alternative strategies. So I'm pleased to introduce my panelists, David Elms and Luke Newman, as Sarah just said. And also, I'm Adam Hetts, Global Head of Portfolio Construction and Strategy. So I run a global team of strategists that are meeting with Janus Henderson's clients every day, and we're providing proprietary analysis and insights on their asset allocations. So since launching this team, we've met with over 5,000 clients and analyzed over 15,000 client portfolios. And over the last year, my team has been asked more about alternatives than maybe the last 10 years combined. And the average client allocation to alternatives in our database of client portfolios has been growing. So this is a great topic for today, and I think one we're going to be focused on for years to come. So David, we'll start with you, and I'll be gentle and start simple. How are you defining alternatives for purposes of today's conversation?
So for the purposes of today's conversation, thanks, Adam, for the introduction. I'm focusing on liquid alternatives, and by liquid alternatives, I'm talking about what it is that Janus Henderson does in this space as things stand today. We don't do illiquid alternatives, we don't do private credit, we don't do private equity, which are interesting parts of the alternative space. In fact, you could argue from some perspectives, are they really alternative or not? Are they really just less liquid versions of standard assets like credit and equity? But that's another discussion. So the focus here is liquid alternatives. It's where a client can receive their money back, typically in a 1 month or less horizon. That's a reasonable definition of liquid alternatives, and it means that the underlying investments are typically standard securities rather than being partnerships, ventures in less liquid funds, and so forth. It's not exclusive. It's not exclusively the definition, but it's a good working definition for what we're here to talk about today.
Okay, thanks, David. And Luke, I've got a different question for you, but first, anything you want to add on defining alternatives in your opportunity set, or should I just move on?
No, I think that was a comprehensive explanation.
Okay, so then next question then would be, as we're seeing more clients looking to alternatives because of the market environment and the comments I just made about our database of client portfolios growing their alternatives allocation, how do you see clients using them in portfolios, Luke? In other words, what are the biggest problems that you think clients are trying to solve for with liquid alternatives right now?
Thanks, Adam. Yeah, a really interesting question and an important starting point to look at when we're thinking about alternative assets in general and our provision of them, and as you say, how we're seeing them used within end markets and ultimately by end investors. And it's something we've seen change over the last couple of decades as certain elements of that alternative market have matured, and we've been part of that maturity process with those products. I would say really there's 3 areas we've seen alternatives products being used by asset allocators and investors. The first, I would say, are sold in and substituting areas of portfolios traditionally provided by long equity products. And generally, investors are aiming to replicate or get close to equity-like levels of return, but without taking the associated levels of risk. We can all think of those dramatic drawdown events and bear markets we've seen over the last few decades, and also the appeal of more alternative assets that over the long term can deliver similar levels of returns, but maybe take out some of the volatility along the way. Equally, we've seen periods where alternatives have substituted fixed income type assets, and almost we see investors investing on a risk budget basis rather than necessarily targeting a return. Again, that's a period we've seen as well. The final category is probably the one we feel most comfortable with, and I think it's also a trend that's been in place and seems to be accelerating, and that's investors allocating more of their portfolio to alternatives as a diversifying asset class in its own right. So holding more liquid alternative type assets, and that poses the question, why would you do that? And it speaks to your introduction to some of what David was saying before. Why on earth would you do that? Well, if done correctly, alternatives can provide that uncorrelated return. So giving you vehicles and funds within portfolios that can deliver consistent ongoing performance. Secondly, I would describe them as shock absorber type characteristics. And that's really been front and center in recent years. The sort of protection that alternative funds can give to investors, and we've seen this firsthand here at Janus Henderson in terms of the protection of those funds through pandemics, recessions, referendums, elections. All of those periods of volatility. Actually, the predictability, I think, is another reason why those allocations have increased. And the final piece really is alpha generation, and that's something that we can see coming more into focus on a forward-looking basis. That actually, the appeal of consistent, stable levels of absolute performance, again, looks pretty attractive in an uncertain environment. So that's why we've seen, I think, the usage of alternative assets increase in recent years.
Sounds relatively straightforward. Uncorrelated shock absorbers at alpha. David, anything to add to that?
I think, and I'm careful about preaching to the converted here with you hosting us, Adam, but I think it's about the investor's broader portfolio as well. So you can't think of alternatives in isolation. You've got to think of what is going on in the background for investors with everything else. And that's both at a headline level. So think of 2022 when we had significant drawdowns in equities, significant drawdowns in bonds. And if you were in conventional assets, those more vanilla assets, there really was nowhere to hide. So that's important, and that creates the interest. But also unpeel the onion an extra layer and think about the composition of a portfolio. If your equities and bonds are going up and down together, so they have positive correlation, then that is a more risky portfolio than if they're going in opposite directions, which is really what we saw for most of the past 25 years or so. You need to go back to the late 90s to see a period like we've seen recently where equities and bonds go up and down together. So what you end up in a portfolio sense is that the two major asset classes that make up the majority of most investors' portfolios, if they move together in sync, then that's a more risky portfolio. If they diversify each other, it's a less risky portfolio. So picking up Luke's point about risk budgeting investors, if they're thinking about a broader portfolio, they're going to want to find other things to do when the major assets in the portfolio co-move are positively correlated. And I think this is where alternatives become attractive to asset allocators. And it's going to drive, not just in terms of the headlines, the obvious reason to move to alternatives, but in terms of that second layer, more quantitative argument, it's going to drive heavier allocations to alternatives. So I think this is an important change to market conditions, and it's a really significant. It's really significant as to whether this persists or is something that is a shorter term phenomenon. And historically, it has persisted for really long periods of time. So it's something to be concerned about and aware of.
Okay, so we're looking to alternatives as that uncorrelated shock absorber, whether investors are concerned about equity volatility or fixed income rate volatility, or even, David, to your point, the traditional 60-40 going through a paradigm shift of how the 60 and the 40 interact, and having alternatives maybe kind of intermediate some of that. So if you're looking for all those benefits in a liquid alternative strategy, then what's most important when it comes to manager selection in this space? I'm not sure if David or Luke, if you want to start talking about manager selection.
I mean, I would say, survivorship bias is is such an important factor in this space. And we see it ourselves. You see new strategies launched, and some burn brightly for a short period, and then we see a kind of long tail of strategies that haven't delivered in this space. Haven't delivered to those objectives and targets and outcomes that we talked about at the start there. So I would say consistency of process, consistency ultimately of performance is critical, but actually it goes with the territory here. It's consistency and predictability of the return characteristics as well. And I would say that those are the areas we tend to encourage our investors to assess and monitor going forward. It's not about knocking it out of the park necessarily within alternatives. It's consistency. It's being there for the difficult markets, the difficult economic cycles, as much as the easier environments where alpha generation presents itself more readily.
Yeah, I definitely agree. I think that the two things, and we've spoken of it a few times already, but alternatives need to generate attractive risk-adjusted returns. They need to make an investor's portfolio accrue value in that sense, but they also need to do it in a different way. If they only do it when equities are going up or bonds are going up, then in what sense are they really an alternative? So I think your alternatives need to be that alternative to traditional assets to add something to an investor's portfolio. So looking at measures like how much of the return of a portfolio is accounted for by the change in equity markets or the change in interest rates is important, because investors carry that exposure significantly in any case. And I would definitely echo Luke's comments about the ability to do this in the long run over different cycles, the consistency of the investors in that process, the consistency of the investor process. And I think also, so what worked 5 years ago, 10 years ago, doesn't necessarily work today. And the ability to adapt an investment process for different market environments is also very important. Markets are always getting harder to invest in, and it's a never-ending challenge in that regard.
So at this point, I'll open it up to any more audience questions I see coming in on my screen. And I'll start with this one. Speaking of markets getting more difficult, any comments from either of you on the U.S. debt ceiling, and if it might create any unique opportunities for you as alternative managers?
Shall I go first? Yes. Yeah. Okay. I'd say this environment, and it might seem counterintuitive, but actually this environment for equity long short, so slightly distinct, but not totally from what David does. I would say we've been enjoying this environment. Yes, it's uncertain, but actually it's a lot more rational, and I think it's probably to do with the fact we've emerged from this long period of QE dominated, low discount rate, low risk-free rate environment to one that feels more normal. And we remember this period. We remember investing with rates and inflation at these sorts of levels. Now they've settled down a bit, so that's helpful. And actually, I think a good proof statement of that is how we've been able to protect against the increasing fears in the market's mind around the debt ceiling, and we looked back historically. 2011 was the case study for us in terms of what happens if things don't get resolved ahead of the date. And this work started 2-3 months ago. So again, we're not reactive. We're always looking ahead. And actually, so far, history has rhymed a little bit. Actually, pressure on domestic U.S. assets, pressure on U.S. consumer discretionary sectors in particular. We've been able to protect against that on our short book and adjust the long book slightly. Pressure on the dollar, again, and actually there's ways of protecting within US markets against that, but actually there's a lot of ways. There's a lot of UK and European listed businesses that have a lot of their earnings in dollars, and then translate them back into euros and sterling. So again, that needed some thinking about. And very quickly in 2011, what was initially a US issue, for obvious reasons, very quickly became had a global GDP knock-on. And then, as now, we've seen pressure on commodities, oil, materials, and again, that's provided volatility for the market, but I would argue so much more rational than we've seen for much of the last decade. So actually, first and foremost, protect along the sort of lines that I've just mentioned, but then really find another way of shock absorbing first and foremost, but actually delivering that consistent, stable, positive absolute return. And that's been our experience of the last few weeks and months.
Yeah, it's a really interesting environment. And I think back to some of the big macro events that we've had, big macro and political events that we've had over the past few decades. And I think these things, in a sense, are becoming harder to predict. So even if you knew, say, the outcome of the US election in 2016, you may not have been able to make money even with perfect foresight. And I think this means that market positioning is a significant factor. So we look at something like the debt ceiling and the potential risk, the two-sided risk, because there is some bearishness and positioning ahead of it. But I think there is also an assumption that, as in 2011, they will find a way through, that sensible minds will come together, compromise will occur, and everything will be all right. And that's generally been the case. But you also have a far more polarized political environment that you had back in 2011. And I think the makings of a compromise, whilst in one sense obvious, are going to be harder to achieve. So when we think about this sort of thing, we're thinking about almost radical uncertainty. It's a bit like Donald Rumsfeld's unknown unknowns. Even if you have a crystal ball that tells you what's going to happen in the real world, the way that markets are going to react can be totally counterintuitive. So in this sort of environment, we rely more on non-directional strategies that do very well in large moves in either direction. So I'm thinking about strategies that have more optionality, that use derivative markets to get those positively convex payoffs. So they do well in big moves up, they do well in big moves down, and this is a good environment for running that sort of risk profile in a fund.
Thanks, David. Thanks, Luke. I think that about wraps us up, gets us pretty close on time. If I try to sum us up in one sentence, it's probably going back to the beginning, that the environment doesn't point to a straightforward approach to just defense or just offense in portfolios. And if my team's portfolio consultations are any kind of leading indicator, we'll continue to see more inflows into this space based on the conversations we're having. And I think, Luke, as you put it, those uncorrelated shock absorbers that can potentially generate alpha seem like the great solution to balance that offense and defense in investor portfolios. So thank you both for your comments. That was great. And thanks again to the audience for joining us and for your interest in liquid alternatives. And we're, of course, happy to have any follow-up conversations after this session, or share any of our team's thought leadership or anything else we can do with all of you to keep the conversation going.